Despite markets dipping downward, volatility has still remained low, and as options traders, that may not be a good thing. In this video, we're going to talk about covered calls and why they may be a better strategy than other options trading strategies when volatility gets low. So let's go ahead and jump right in. First off, let's define what a covered call is. A covered call is an options trading strategy. You as the trader own the stock and you sell a call against that long position. And as the trader, you collect the premium for selling that covered call option, which gives you some downside protection as it reduces your cost basis in the trade. In order to do this trade, the trader, you, must purchase your stock or own stock in 100 share increments. One point that every covered call trader must understand, and many don't, is your cost basis. If you bought the stock, let's say you bought XYZ stock at $10 a share, and you sold the covered call against it for $1. That means you spent $10 on the stock, they paid you $1 for the option, which gives them the right to buy the stock from you, and that lowers your cost basis down to $9. You take your stock price, 10, subtract from it any premium you've taken in, $1 in this case, your cost basis is now 9. If you still own the stock next week, next month, and you do it again, that would bring your cost basis down, if you took in another $1, to $8. So you may be asking, why is this strategy better when volatility is low? When volatility is low, premiums for options are lower, which makes it less attractive for traders to buy options. You might be asking, why is this strategy better when volatility is low? One of the things that I really like about it in a low volatility scenario is you don't get the whipsaws. You get a very high volatility, or what is known as a VIX. You get a whipsaw effect sometimes on stock price, which means you might have bought the stock for $45 and it moves up to 52 and drops down to 38 all within that same time period. That lower volatility usually lends itself for a smoother move. So by having a lower volatility, it just protects you as the buyer that there's less chance of the whipsaw where the stock moves up and down in dramatic fashion. So let's take a look at the chart. The chart that I've got up on the screen right now is of the VIX, which is the volatility index. And when we look at it, let me go ahead and zoom in a little bit on it for you. Right, when we look at this, it's a chart. It's a price chart. I don't necessarily use the moving averages on there, although some do. It's not really something that I focus on. But I do have these colored zones in there that are extremely important to me. The green zone represents the normal of what I want to see the VIX at. Now that is me, Rob, as a trader and what I trade. So why I have it set green at 18 on the low side and 29 on the high side is I'm a seller and a buyer. I do both. So that gives me a good average of where we are. So my bias on here would be a medium, which is the average, right? We're not low, we're not high, right? We're medium on here. By being in this range, it gives me the opportunity as a buyer to not pay too much, and as a seller to still find enough premium. If you get down into the yellow zone, which is under 18, covered calls are awesome there because you get a directional move and it's just slow and steady wins the race. But you are more hard pressed to find a lot of good candidates when you get that much lower VIX. We lived with the VIX at 11 for a long time, not long ago, and it was harder to find really good covered call premiums on the positions because of that. That 18 to 29 gives me enough of a range that I still get decent returns on my option trades where I can pick up that 3 to 5% a month, which is, Rob, my personal goal. 3 to 5% a month, and I trade them weekly, but I'm looking for that monthly rate of return there as a potential. So if we do happen to make it back to 11 at some point, and I believe we will in the future, if we do get back to that 11, you can find covered calls. You just have to be more selective getting enough premium. Make sure the minimum premium you would receive fits your risk profile. Now, if you get into the red zone, premiums get a lot higher, but so does the whipsaw. So I'm a little more cautious, again, on the trades that I take up there. So in other words, in the green zone, I'm more loose, where I'm freer to take multiple trades in there. In the red or the yellow, I really need to hone in and make sure it is the right trade only that I'm looking to, because premiums and that whipsaw. So let's go ahead and bring this back a little bit to a much higher red zone, right? So you can see I don't go all the way back with it. I can. It just, I haven't dragged it all, right? It's just crazy trying to get it to move sometimes the way I want. But when you get up into that 37, you see how long it stayed up there. Very little. It stretched up and it whipped. So what happened? 3, 4, 5 days, maybe 8 or 9 days, you get a quick move up and down, which is that whipsaw that takes place. Those are the days that the Dow opens up in the morning at 9:30 Eastern time. It opens up, let's say it is literally up 600 points, and by noon it's down 800 points, and it settles out at the end of the day down 100, right? You get this whip that took place all throughout the course of the day, right? I want to avoid that, which is why I want to stay away from those trades when we get into that higher vol. And remember, if you're getting that higher move into the VIX, the options pricing is exploding to the upside. See, volatility, or the VIX, measures 8 options contracts. And when you have a strong bullish move in the market, stocks going up, S&P is going up, the VIX is coming down. When you have a strong bearish move in the market, the S&P is coming down and the VIX is going higher, which represents in higher options prices across the board. So now let's look at the covered call strategy in lieu of this VIX conversation we just had. When you sell a covered call option, you, the investor, the trader, collect premium, which provides a cushion against a downward movement. Why? Because whatever you got paid, 10 cents, 50 cents, $1 million, that comes off of your cost basis in that transaction, in that trade. So the cushion will help offset some loss, some risk, as your break-even point continues to drop, the more that you continue to write covered calls on that stock. Conventional wisdom has to ask the question now of, we talked covered calls, what about other selling strategies like diagonal spreads? Does this apply? And the answer is yes, it still applies. You will find, depending on where that VIX level is, it becomes easier or harder to find the right candidate to trade. So use the rules I laid out on the VIX to help you, whether it's a covered call or a diagonal spread. In conclusion, covered calls are a better strategy than other options trading strategies when volatility is low, because they provide a cushion against downside risk and generate income for you, the investor. So if you're looking for a strategy that can help you to navigate low volatility environments, then covered calls may be the way for you to go. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Go ahead and check out some of our other videos right here.